Okay, thank you all for joining us for VentureCrushFG today. Welcome to those of you here at Lowenstein's New York office, and welcome also to those of you who are joining us remotely on Zoom. We are going to look at the stuff that's in the chat, and we appreciate the opportunity to spend time with you. I'll do a couple of announcements. For those of you here in person, if you'd like to participate in the chat in our live Zoom, scan the QR codes that are on the screens or in the handout, but don't activate audio because it will sound, atrocious, and we'd love to avoid that. The bios for Aileen and Karen are linked. We'll drop that link in the chat. We'll drop some other links in the chat as well. And you should definitely drop questions for them in the chat. And we will try to read them on this tiny little screen right here and intersperse them, as well as taking some live questions here. Special thanks to our Lowenstein Sandler colleagues, Nigel Pura-Bryant, Tina Ayoun, and Spencer Cow for research help for today, as well as Latoya Bethune, and also our Lowenstein Sandler events team, Brittany Harlos, Owen Lewis, Jenny Amador, Ginny Wagner, Angela Brondum, Karen Martins, Ariel Williams, and of course, Carrie Fisk. We'd love for folks to introduce themselves to one another, and we encourage you to connect. Tell us who you are in the chat, include your LinkedIn. We know that people have been connecting that way, which makes us really happy. As always, we are using closed captioning for today's event. Also, our Women in VC group will be hosting a cocktail hour during Tech Week in New York. Although, it's always Tech Week in New York. It didn't used to be 20 years ago, but now it is. That's on October 17th from 5 p.m. to 7 Eastern, right here at Lowenstein's New York office, hosted by our LS colleagues, Meredith Bushaw and Laura Cicerelli. They're great. There's a link to register in the chat as well. And this is the last session for this wave of our 2023 VentureCrushFG pod companies, which we've really enjoyed having these companies with us for this session. And we look forward to having a new set. So we will reopen the application process. And if you want to be part of this pod where we try to help build a community of founders, we don't take equity. There is no pitch or demo day, and there's no charge. It's about building a community of folks and having an expanded network. So it's been a very fun thing. Also, you'll notice that we did, it's not really vaporware. It wasn't intended to be materially misleading, but we did tell you that we would have Austin Clements from Slauson & Co. and Jeff Busgang from Flybridge and HBS with us today, and they couldn't be here. We look forward to including them another time soon. A number of you saw Jeff's moving posts on social media about the very, very recent passing of his father. We send our deepest sympathies to Jeff and his family. Jeff, like Aileen, has been involved in this part of the VentureCrushFG program since we launched in 2008, when there weren't that many VCs who felt New York was worth covering. And he's been an amazing supporter and friend. We wish him an easy grieving period. So on that very happy note, we'd like to start with a little bit of background on both Karen and Aileen. We'll ask you each to talk a little bit about yourselves, and then I have some questions, and maybe we'll start with you, Karen.
Sure. I'm Karen Page. I'm general partner at B Capital Group. We are located in multiple cities. We don't have one core headquarters. We're Singapore, New York, LA, San Francisco. I'm in the Bay Area most of the time. And I'm on our early stage team. So I focus on seed and A stage investments, working across enterprise and healthcare primarily. And the entire fund of B Capital goes all the way through exit. So we try to partner early, take you all the way through an exit of whatever kind that might be. And my background is as an operator. I've been in venture, and I give huge hat tip to Aileen for helping me get into venture. But I was at Box. I was employee 7 at Box. I stayed for almost a decade through our IPO, and then I moved over to Apple, where I worked on the enterprise team there. So I'm kind of a go-to-market thinker in my approach working with our founders.
The go-to-market
Thinker. I like to.
You're an amazing go-to-market coach, I think, for any company that's selling to enterprise,
Thank you.
SMB or enterprise. I mean, Karen has done it all. So awesome board member and to have.
I have heard the awesome board member term be applied to you as recently as yesterday when you were here in our office at a board meeting for one of your great growth companies.
Thank you.
So, yeah.
Appreciate that.
And when you started at Box, it was kind of a crazy thing for you to do. You'd been at Prosper, which was another startup, and it's 2007, so you probably didn't know that the bottom of the market was just about, like the bottom was just about to drop out. You were a single mom with 2 small kids, and you thought, now seems like a fantastic time to risk everything and go join a company that's raised a total of $1 million. And I feel like I should say $1 million, right?
With no revenue.
With no revenue. And
Yeah,
half the
sounds
founding team, you're the 7th employee, half the founding team was under 21 years old.
That's true.
So what exactly were you thinking?
Thank you for pointing out my lack of rationality. I do think I am by nature somewhat of a risk taker, and I think you have to be at the early stages of a company. I did this is totally inside baseball. I did try to leave, and Aaron wouldn't let me. So I did tell him that I was going to take a more
Grown-up job?
I mean, you took the
There's-
job, you showed up, and you're like, oh no, actually.
I took it as a consultant, so I
Okay.
eased in, and I was like, I'm gonna stick around. I'm gonna do all these things. And a couple months later, I got, at the time, what I kind of thought was a dream offer, and I told Aaron that I was gonna go take it, and he said, "No, you're not." So longer story, obviously, but I didn't, and I'm really happy I stayed. I mean, it was really something that I really wanted to do, was join an early stage company. I mean, it's a Silicon Valley dream: join an early stage company and experience an IPO. And so we fulfilled that dream, and it was a brilliantly fun, immensely, opportunistic time in my life. It was really, really fun. Mostly 100% of the time.
Mostly 100%.
Yeah.
Okay. That's good. All right. So Aileen, tell us a little bit about your background, maybe mention Iowa even.
And I don't know where you find the time to listen to Arcane podcast.
I don't know anything about sports.
I don't either. I don't listen.
Helps a lot.
He was my mom is an immigrant from China, and she basically came here on her own. She didn't know anything, and she got a full scholarship to a very small college in Iowa. So that's where she came from China to Dubuque, Iowa. But I'm super happy to be here. I was going to ask you actually when this started, and so it's pretty cool, the number of companies and the number of founders and tech executives and VCs who have come to be a part of this community. So congratulations and thank you. It's really awesome. So Aileen, I'm I guess a long-term venture investor. I'm the founder of a seed stage firm called Cowboy Ventures. We generally like to co-lead and co-invest with other folks, and in seed rounds, we often invest pre-product. So about 60% of the time, the founders need the money to actually build out the product, and then 40% of the time they have something, but we do start pretty early. We invest kind of across the board in technology-oriented companies. I would say it's probably 75% enterprise software, 25% consumer, and that's kind of where I've gravitated over the years. I spent about 12 or 13 years at Kleiner Perkins before that as a Series A, Series B investor, and then I moved to seed. I'm originally from New Jersey, so I'm always very happy, actually same town that I just live in. So I'm always very happy to come back here.
And you also did not have a straight line into venture. You worked at well, why don't you talk a little bit about selling schmatas?
So I worked at the Short Hills Mall. And then after college, I did investment banking for a couple of years. I moved to China for a year and I taught English and kind of backpacked around. And then in business school, I actually always loved consumer and I kind of had a fascination with brands. And so this is kind of pre-internet. So I thought, let me find some kind of emerging brands. And so I went to the library and I would like read old ink magazines. I think I had to get like microfiches, if anyone here remembers what microfiches are. And I've heard of this company called the North Face. So this is a pre-public private company in the East Bay. So I worked at the North Face and then I also worked at a little juice company called Odwalla. And then I went to Gap after business school and I did a couple different things at Gap. And then the dot-com boom was happening. I was living in San Francisco and I wound up getting an accidental job at Kleiner Perkins, which wound up being my dream job.
Why do you say it was an accidental job?
So I had heard of venture capital when I was in investment banking, and generally it was all dudes who were getting those jobs, either in private equity or venture capital. And there would tend to be like two types of dudes who would go into those jobs. They were either, guys who kind of grew up in Darien, Connecticut, and their parents, like were lawyers and bankers. They had, been going to the country club and playing golf with their dad and their dad's friends and talking about stocks like in high school, right? Or it was kind of gunner immigrant guys who were like wearing a bow tie to work and like carrying a briefcase and reading the Wall Street Journal. And like, that was not me. And I just figured I didn't want to work in a job where I'd have no friends. And so even though the work seemed really interesting, I just figured culturally I would never be a match. And you're going to thrive when you actually feel like included and supported and welcomed. And so I just figured that like the work would be incredible, but I would never be welcomed.
So you talked in some interview about a recruiter calling you and you saying like, venture is all dudes. Why would I take this
I got really
interview?
lucky.
And and can you talk a little bit about her response?
Yeah. And this is, I think, partially like what drew Karen to venture as well, right? It's like, I was at Gap and I was kind of the product manager, marketing manager, catch-all first biz dev manager for Gap.com in 1999. And I got a call from a recruiter. This firm, Kleiner Perkins, was looking for an associate. And the partner who was looking for the associate had told the recruiter, I would really like to make sure that we consider female candidates. And because we don't have any women at this firm. And so the recruiter told me that, and I was like, God, that sounds horrible. Like, there's no women at the firm. I would be the first one. No, thank you. And she was like, I gotta tell you, Aileen, this is a really hard search. If I can't even get you to come on the interview, no women will ever work in venture capital. And I was like, it's kind of working on me. So she's like, just go meet them. She's like, just go meet them. Like, just go interview, And so I went to go meet them, and I was fortunate because I didn't know anything about venture capital, so I wasn't intimidated. I interviewed with Vinod Khosla. I had no idea who he was, so I didn't find it so intimidating. And so I wound up getting the job, and I stayed for 12 years. But it kind of like for any of you, regardless of what your role is, if you're a manager, if you're a founder, like just know the power you have. Like if she hadn't said that to me and said like, I'm really having a hard time with like a little vulnerability, a little humanity, right, and a little encouragement, I would not be sitting here today.
You still in touch with her?
No, she retired. She's living her best life in Hawaii.
Sounds like she was a really good recruiter.
Yes, very good. Very good.
All right. So one last thing. Allraise?
Yes. So it's something we're both involved in. It's a nonprofit, allraise.org if you want to check it out. It's how many years ago? It was 5 years ago. For many years, I think tech has fashions itself to be a meritocracy, right? I think we all know that for many years it has not been. And I think about 5 or 6 years ago, there was, Susan Fowler wrote this blog post about her weird year working at Uber, right? And she just did it in such a smart way that kind of really told the story about what it's like to be a woman in that kind of a culture that I think caused people to actually believe it for the first time. And then there was this venture firm called Binary Capital, where one of the partners had kind of been alleged to serially be harassing female founders and even coworkers. And then an article came out and the fund folded. And it kind of felt like there was like this series of events where data points were actually happening, where people could no longer pretend that this didn't exist. And so a bunch of people in the industry were getting, in particular women, were saying, hey, like, this is our window. If we don't do something to actually try and drive a chuck for this increased sensitivity, that we really don't have the level playing field or the diversity in our industry that we should have. If we don't try and do something now, we never will. And so a bunch of women in venture capital got together, and we basically just started planning, like, okay, what are the root causes and what are symptoms of why there aren't more women and people of color and other kinds of minorities in the tech ecosystem as founders, as VCs? Maybe we could do some boot camps for female founders and for founders of color. Maybe we could do some boot camps for women, younger women in venture. Maybe we could do programs to try and help principals become partners and help partners become GPs and help GPs be more successful. And then if we can do things to influence the men who are running the firms to take the bias out of the recruiting processes and hire more women and people of color. And we just kind of started working on stuff nights and weekends. And so now it's a nonprofit called All Raise, and we have lots of programs, and we're making progress on the venture side. When we started, 75% of venture firms had not a single woman on their team. And the way we describe it is like, imagine in 2020, you were thinking about sending your child to university, and 75% of universities had not a single female professor. Would that seem normal to you? It would not, right? Like, that's how the venture people are supposed to be your guides and your coaches and your board members, and they just really had no diversity of thought around their tables. So that has improved, and then women at the time were 8% of the partner level people in venture, and now we're at 14%. So it's still pretty pathetic, but we're making progress.
But isn't in the general population, women are only about 14 or 15%,
Yes,
right?
yes, right. Yes, exactly. Yes.
Maybe I have to check those stats. Yeah. So, and All Raise has kind of shifted to be very, very inclusive, and originally, like, there was more of a focus on gender. We didn't solve that problem in venture. We've done less to solve other problems in venture. Do you feel like and this is really for both of you, do you feel like in the constricting market where people are worried that the sky either has fallen or is falling, that there's going to be even less? Or do you think that, like, now we will see even more because there's more consciousness about this?
Oh no!
Wow, what a face!
Making a sad face.
I think a lot has changed. I've been lucky enough in my career, both at Box and at B Capital to really feel strongly that the highest levels of management are fully inclusive and strive to have a very balanced workforce. And I believe that to be true. I still think it's hard. It's very difficult. It's not, I've changed my perception just slightly in thinking that there were just hordes and hordes and hordes of women that were dying to get into venture, into thinking that there are fewer women trying, and it's therefore even more difficult to find them. We hunt hard for the women we find.
I think there are more. It does start at the top, right? Just like if you're a CEO or if you're an investor and you talk to your CEOs, like, culture starts at the top. So, and the reality is that most people running venture firms are men, white men. And so I think, like, partnership, it can't be like the women or the people of color trying to change the whole industry. Like, we have to be partners and lock arms together as an industry to try and hold every seat open, to Rooney Rule every hire, to be very purposeful. And if you're a founder, raise your hand if you're a founder in the room. Okay, so you all, a lot of founders here. So, when you have choices for who you're calling for your next round of funding, like, take a look at who's in your spreadsheet or your Google sheet and look at the gender and the racial and the all kinds of background about who you call. And, like, we've sat in so many board meetings, and I know you have too, right? Where, company's doing well, and let's say we're thinking about calling someone for the Series B, right? And usually we're the only woman in the room, right? Or my colleague Jill may be the only person of color in the room. And, someone will be like, oh, how about Matt? I saw him last weekend at the basketball game. He's such an awesome dude, right? And then someone will be like, oh, yeah, right, Matt. And then someone's like, oh, how about Scott? Like, he's such a good guy. And then I might say, like, oh, how about Karen? And someone will be like, oh, does she do enterprise software? And it's like,
She
yeah,
does.
She does, and she's awesome. And, and so it's like the calling attention to the fact that people ask different questions of different kinds of people, and that actually, if someone's a good guy, that has no relevance on whether they're going to be a good investor in your company or if they're going to be a value-added board member. Like, that is not the right, but like, they get a pass. And if you don't say something, then people keep letting it happen. So I think those are just all little things that all of us can do in the course of business to try and make those changes.
Yeah, we like the hiring process on the funding side, we should be easy to find, right? We're right out here.
Yeah.
And frankly, you can also look at the All Raise website and find funding sources
Yeah, and the
there.
Black VC website and the Latinx VC website.
You can
Yeah.
even look at the First Close Partners
Yes, that's
website and find funds that you want to invest in that are owned and operated by underrepresented folks, funds that you want as investors. So yeah, no, that's a great call to action. And I did like your comments. I think it was a couple of years ago where you started saying like, maybe we should think twice about using the phrase "good guy" because there's no
female equivalent. Like if someone says, "Oh, she's such a good girl," like would you
Different.
What does that mean to you? Does that, like, honestly think the first thing is maybe, "Oh, she's obedient."
Yeah.
Isn't that weird? Is that what you thought? Right? If someone says he's a good guy, what does that mean to you? He's fun to be with. He's like easy, right? Like it's not equine, so we shouldn't use it.
There is actually
He's a good boy.
there's a famous winemaker in California who tried to get a wine labeled as the good girl, and the government said that's inappropriate. We can't do that. So he resubmitted under the name The Hussy, and they're like,
geez.
and they're like, that's totally cool. Yeah. Okay. So so there was
We should open a wine label. It's like the male slut.
Everybody would be
What is
like,
the
"Oh,
male
he's a good guy."
Is there a male equivalent to hussy?
himbo.
A himbo?
Rake.
Rake?
Yeah. Yeah.
British. Okay, so we are talking about the current market, not for himbos, but the current market. You, Aileen, you said, and I'd like to hear from both of you about this, that we might be in the age of Ozempic for startups, chasing growth where capital was free, you could spend a lot of money, speed and growth was more important than focus or discipline. And I believe that you were talking about startups and growth companies, but I think it also applies to venture funds themselves. And we're going to see a recalibration there. And I'd like to hear from both of you about what changes you're seeing that maybe have not been announced or are not being spoken of publicly, both at the venture funds and also at the startups and growth companies in whose boardrooms you sit.
You want to start?
No, you go ahead.
All right, I'll start with startups. Like the venture, we have lived through this before, right? Like after the .com boom, there was quite a contraction for a number of years, right? After the Great Recession in 07, 08, there was a contraction. That basically, interest rates were zero. Tech is an incredible category to be in. So congratulations for being in tech. Software is an incredible business model and technology is a huge enabler. So like the macro of tech and software and the power of it to change businesses, I think is huge. But the reality is until about 2 years ago, like the 3 years or 5 years prior to that, the public market run up due to a bunch of different factors caused public companies to be valued at 30, 50, in some cases 100 times revenues, right? And that trickled down to the private markets. So if you were doing $1 million in revenue, you could be worth 100 million or maybe even more as a private company in terms of your valuation. And when public market multiples compress significantly, where now the best in class SaaS companies are trading at 6 or 8 times revenues, that is trickling down to the whole supply chain of private companies. So that does not mean, unfortunately for me as a seed investor, that if you're doing $1 million in revenue, your company is now going to be worth 6. Like there's not perfect symmetry between public markets and private, but for sure, the valuations of 3 years ago, with the exception of horizontal AI, I would say, is, venture investors have indigestion. A lot of them, especially with the big funds, are over their skis, having paid way too high prices 3 or 4 years ago. And so they're kind of looking to cost average down their portfolios. They're looking to slow things down because they spent too much. They need to and they're not going to be able to raise same size funds when they go back out again. So they're kind of trying to instead of going from deploying all their capital in 2 years, they may deploy it in 4 years. And they're going to be really picky with what they invest in because they're investing now assuming that multiples will probably stay where they are. And so and their funds are really big. I'm sorry, I know I'm kind of giving you a lot of things at the same time, but so the going in entry price matters a lot for these investors. And so that's really changing, I think, the amount you can raise and the valuation, even whether you can raise. They'd rather sit on the sidelines and kind of wait for the perfect wave than keep deploying because that's what they did during the heyday and their investors are going to punish them for it. So I think it's really smart. And I think there's also the economy is still quite bumpy. We are not out of the woods. 2023 has been, I think, very challenging especially if you are selling enterprise software. Enterprise budgets are pretty locked up and they're shrinking in a lot of cases. And our expectation is that will be the case in 2024. And so you kind of have to ride out this very bumpy economy, potentially through to 2025. And so that just means you have to do more with less, you have to spend less, you have to be more focused. Those nice to have opportunistic engineering or product or marketing things that you were going to try, they're probably going to get cut. I think startups just have to be much more focused on, but constraints create creativity. People are going to do incredible things, I think, in the next couple of years with this increased discipline and focus.
I couldn't agree more. And it's an incredibly complex set of ingredients to, a non-scientific formula. I think, certainly what you were saying about the complexity between looking at compressed valuations with companies who may have raised at valuations that were then appropriate, now too high, that have to grow into these valuations, and balancing their burn against their ability to get. I always say to my companies, revenue solves everything. As long as you're selling stuff, you're fine. But that's also compressed. Those sales cycles not compressed. They've expanded. Yeah. We need them to compress. So it's taking longer to sell. It's a more uncertain market. Money is more expensive. Valuations are somewhat upside down. And so, I really feel for founders who are in those situations because the pressure increases. You have to figure it out with less money, less time, and probably fewer people. And, that's where, to your point, the creativity and the persistence and, the ability to really look at the market and try to predict where the market's going and, huddle with the people that you trust to, get down to the basics to build the business. But it's a tricky time. I hope you're wrong though, Aileen. I hope it's not 25. Can it please be 24?
I know.
The IPO window, maybe just.
Well, it's funny because I was with some bankery people and public markets people recently, and they were talking about how, we have this little burst of 4 or 5 companies that are going public right now. And then there's not a big backlog behind that. So it's just kind of what's happening right now in kind of September, October. And then they said there were 300 something people who registered to go public 2 years ago. And only a third of them could actually go public today. 2/3 of them they were overvalued. Their business models aren't right for the time. The margins are bad. The burn rates are too high, whatever it is. So those 100 they're probably going to wait for clean audits. And so they won't get their audits back until March. So maybe they would go out because they want to go out on 2023 numbers. So the earliest they would go out, and you probably have more perspective on this, would be spring. But then you've got the elections in the fall, and no one's going to want to go out in the fall because it's going to be so potentially turbulent. And so you kind of have a very short window where some companies will go out, but it's not going to be the whole year. So I think that's going to hinder things a little bit.
I do like how we are now pricing into the stock market the political risk of a peaceful transition of power for a presidential election in the United States. That's not a great fact. So I want to focus on two of the things that you folks just said. And one of them, Karen, ties back to something you said in an interview you gave where you talked about hunters and farmers and on biz dev and partnership teams. And you talked about the need to be patient for revenue because some of the seeds that the farmers are planting do take time. And then just now you were talking about expanding or elongating sales cycles. So how do we balance the immediate need for revenue with the knowledge that we have to actually be patient because it does take time when you plant those seeds?
Well, I mean, I am a partner person at heart. I love partnerships. I love the strategy around them. I like developing the templates and the platforms that enable companies to have very robust partnership efforts. But it requires people. It requires somebody who in the very early days can be both a hunter and a farmer. And by that, I mean somebody who can have the strategic vision to say, like, this partner has the same customers that we do. And even though they wouldn't necessarily pay us to partner, maybe they'll introduce us to their people. So it may not generate revenue on day 1 or 2 or 10, but over the long haul, they're putting us in the right place to build our own relationships. And, some of the, really successful efforts that we had at Box were like with NetSuite. And at the time they had this little random storage box on their website. And I was like, why don't you just replace that with Box? You won't need to manage that anymore. We'll just come in and replace it. And I also, as an aside, I also had a sentence that I had to repeat to the executive team time and time again, which was say yes until you have to say no. Because if you say no right away, because they'd be like, no, we can't do that. You can't do that at NetSuite. You can't replace. Then everything would die before it even had a chance. So we always said, say yes until you have to say no. But then it turns out that we did that. We did. We went into NetSuite. We replaced their storage thingy, and we became the backup, for all of the things that were happening. I'm actually not even sure whether that still exists, but it did at the time. It was fantastic. And then we started getting our sales reps together, and they became friends, and they'd send deals to one another. And it was the perfect partnership over the long haul. But it takes time. And so I would also often say, this is a marketing partnership. This is just to get our name out there. And we have massive successes there. Does anybody remember when the mini computers came out? Does anybody remember them? These little tiny computers just before the iPad, and so we got really, really lucky with Dell, who had a mini computer coming out, and they realized that they had not enough storage on board onto their computers, and they were like, oh, I had built relationships there already, and they were like, let's call Karen and let's see if there's any way that we could do storage in the cloud, and then they'd be competitive with this. And it was remarkable. It didn't generate any revenue for us yet. It did eventually, but we were on every box in every store. We were on every ad. We were in 120 articles the day after they announced it. And it was incredible, but it took a while for that to generate revenue. So that was a marketing type of partnership. But I know I've veered away from your question just a little bit, but.
No, I think that's great. And then the question then is, how much of your resources do you allocate as you're doing, Aileen just gave us the, it's a time of famine. Many of you are going to die of starvation, but no, it's actually a good thing. It's a good thing. No, put on shoes that are 5 sizes too small because you'll feel better later. It's good. It's good. So, by the way, love your kicks. Great. But how do you allocate resources to that when it's what have you done for me lately? How are we going to hit these milestones that get us funding? Because without funding in a market that's risk off, we don't live.
Yeah, it's totally fair. And I do remind people that I work with when they're talking about structuring partnerships that it does require people. We did a deal with AT&T that was done probably with 2 people. It was probably Aaron and me that did the deal with AT&T, but they had a sales team of 1,000 people, and they needed people from Box to come in and teach them how to sell Box because they were selling to their small businesses. And that requires a team. that requires a team of people that are willing to literally go from one office all the way through every office and then start over again. You know, you need 4 or 5 people to do that. So you really have to be thoughtful about what it takes, because if it fails, then you've not only wasted time, you've probably hurt your credibility a little bit.
But I think channels and partnerships, like startups have been talking about that more, even in earlier stages, because you have to get more creative and do more with less now than 2 or 3 years ago, in a lot of cases. And I also think, just to get back to what are some of the things that you do in these tougher times, right? We basically have been working with our portfolio companies, and probably every venture firm has, right? Which is going back and looking at your product, like, how do you measure ROI? Because basically 3 years ago, you could, if you're an early stage company, you could sell a lot of your stuff to venture-backed startups because they did not have legacy technology and they had like more money than time or people. So if they could buy a software product from another startup that would help them like get there faster, they would do it. And a lot of those companies are going away. So if you currently have a product and you've sold a lot of your products to venture-backed startups, you're probably seeing a lot of churn, right? Because some of those companies are getting their budgets cut, some of them are not going to make it, some of them are having to consolidate. And so then you have to think about, okay, who am I going to sell to in the future, right? And thinking about the value proposition of what you have and just making sure that you're not a nice to have, that you really are a need to have, or that you can retool both what the product does, but also kind of the time to value, making sure the end user is measuring and is able to quantify the value. Then you have to kind of really look at your positioning and your messaging and like how you tell a story, because end customer is looking for a lot more ROI than they were 3 years ago. And so kind of a lot of companies are having to reposition kind of their messaging and how they tell their story, and also who your buyer is, and who oftentimes now in an enterprise sell, you actually have to be able to sell to the CFO and the CISO, not just the head of engineering or the head of sales or the head of marketing, because the CFO is now kind of like saying yes or no to a lot of things. And so you often have to think about like kind of who you're selling to and mapping the organization in a much more careful way than you used to. Yep. But all those things actually are the right things to do. We just kind of got a little break from doing them for a little while.
And we got a break because it was just like growth, and sales were easy.
Yeah.
So now that we have to like earn it again.
Yeah.
Karen, you've talked about having to find the right partner on the other side. And when you walked into NetSuite, I don't know if you like immediately stumbled onto the right partner, or if you tried 5, 6 different people until you found the right person to be the internal champion there. But how do you identify that person? And can you maybe give an example of where you did that?
Well, NetSuite was a little smaller then. I went right to the CEO. But, who then, of course, gave me straight over to their equivalent to me, the guy who ran partnerships there. But I established a really strong, I established a really strong relationship with Zach, the CEO at the time. And that was extremely helpful. But I also really believe that you have to match up, salesperson to salesperson, sales manager to sales manager, VP to VP, CEO to CEO, so that you've got all of these different ways that you can layer in your rebuttals to a no or something like that. You gotta be able to have backup. Like if it's just me and I have to have all these relationships, a no is going to be a no is going to be a no. But if I can bring in new thoughts and new approaches, so build a model that allows you to have various touch points with the right level of seniority at each touch point. Because too junior to too senior doesn't work. You need senior players.
So don't go in alone. And the same for venture funding in the current market? Do you have to bring in like a whole posse?
No posses.
When you're hunting cowboys?
I don't think so. I know there's a leader of an accelerator recently who wrote a blog post, and she said, I hate to give this advice, but I just have to say it, that if you're a female founder, bring a man with you.
Does the man have to work at the company?
No, he just has to be a good guy.
Yeah, I do not agree with that advice. I don't think that, look, small companies are usually founder-led sales. Like, obviously if you're further along, you can, you have, but like tons of companies, the CEO is selling, and that's how you get there. But I think there is a lot of venture money, and there's a lot of funds who are doing seed now, more than ever. So I don't think.
Okay, I want to talk about those two things you just said. There's a lot of venture money. So we've got this like really interesting dynamic, and because I am in the midst of like a heavy part of the semester at Columbia Business School, where for the last 18 years I've been teaching venture capital in the MBA program, I'm like steeped in my slide decks for class, and your partner Jillian was just one of our guests at class this week. She was great. And so some of the data that I have been discussing with class is venture capital underperformed buyout strategies last year for the first time since 2017. And in 2019, we had more than 1,000 venture firms in market raising a fund. 11 of those were in market targeting more than $1 billion. Those 11 were seeking 24% of all capital being raised at the time. And while private equity as an overall category has been net positive cash flow each year since 2011, other than 2019, that's not true for venture. And when I say private equity has been net positive cash flow, what that means is investors who invest in a private equity fund commit capital to that fund and then make their capital calls. They pay in the money they've committed to that fund. The fund then sells stuff, right? They sell the companies they've invested in, and they do what funds are supposed to do. I mean, maybe not in venture, but elsewhere, which is return capital, and they give back money. And the reason that it is cash flow positive in the PE category broadly is because they have, and brace yourselves for this, they have given back more dollars per year than they have taken in commitments from their LPs in that year. So if you are a repeat investor in private equity, you might think that you can have a sustainable portfolio of funds because it is flowing cash back to you every year, more so than you are committing. The run-up in venture has meant that, by contrast, venture capital has been cash flow negative in each year since 1998.
Wait, what?
Except for 2014. And the reason that venture has been cash flow negative is because we're pigs and we keep raising bigger and bigger funds. Now, I'm not saying that you've raised bigger and bigger funds. You have, but I'm not saying that. I'm just saying
Thank you.
that as an industry, the funds get bigger and bigger. In fact, I think the data shows 70% year over year. They get bigger and bigger. And so for the last 25 years, except for 2014, which people didn't expect, venture has been cash flow negative, and people, have come in as the market was exceptionally frothy. When you combine that with a clipped fundraising environment, for the first time in many, many years, I think almost 20 years, the net assets under management in venture have declined. And the reason that they've declined is not just that the last cycle of funds being raised by venture capitalists has been tough, so less money has been raised by the venture funds themselves, but it's also because people are marking down their portfolio companies. And most recently, the markdown was a mere 300 billion, which is a lot of billions. And so the question is, yes, there is a lot of money in venture right now. 15 years ago, there were some funds where they called capital from their LPs. They told their own investors, hey, we're doing a deal on Thursday, please send your check. And the investors said, actually, we think you're going to wake up tomorrow and realize that it's a bad idea to fund a deal on Thursday. So let us know what you really think after you've slept on it, because we might not be sending you that wire. We would never default, but we think you're going to wake up and feel smarter about calling our capital. That's a thing, right? That's a 2008 thing. CalPERS did that. Are we going to see an environment in which the venture funds are really getting squeezed? Because there is a lot of capital to deploy. People have slowed their pace. People have moved earlier stage because they're afraid of writing those big checks with the IPO window shut. So I know I've given you very little data and you should be able to assimilate it on the spot, but what's the deal?
The most obvious thing that pops up for me is that, venture is a longer time commitment, a far longer time commitment. And we've seen, that, 10-year expectation, kind of stifled by some of the other things that we've already said, which is growth has slowed. The macro environment is difficult. They might need more money to get to where they need to go, where they want to go. And I think, it's like I said earlier, it's just adding to some of the complexity around trying to figure out what the right thing to do is. LPs, they want their money back. Like ideally, LPs are like, oh, great, you've written us this huge check, we're going to write you another one. But in the absence of that, they take a longer time to decide what they want to do. And you're right, they aren't loving capital calls right now because they haven't gotten their checks back. So all of the macro market cycles are impacting the way that pension funds and other LP investors are making their decisions.
Yeah, I agree. I don't think venture funds are going to get squeezed. I think they raised really big funds last cycle because the money was available and valuations were really high. So I do think a lot of people will raise smaller funds. So, if someone raised a $1.5 billion fund last time, maybe they'll raise $1 billion fund. Or if someone raised an $800 million fund, maybe then when they go back out, they'll raise 600 or 500. But they'll elongate the investment period for the fund that they're currently investing. I do think that the LPs who invest in these big funds, right, they are managing in some cases, like, trillions of dollars, right, where they're trying to build a portfolio across asset categories, right, and money's coming out of China, but they're investing, in different geographies, they're investing in debt, they're investing in real estate, they're investing in private equity and venture, and they just want to have allocation across these categories. And in some cases, they need to park very big checks. So the years that they were able to get 4 or 5 or 6 times their money were kind of anomalies because really all they need is 2 to 3 times their money. If I'm a sovereign wealth fund, I'm, the government of Singapore, or I'm the UAW pension, right? I've got cajillions of dollars and I'm just trying to deliver 15% year over year. So I think that's the reality is yes, venture capital's got really greedy. There's a lot of bad behavior. They'll get slapped on the hand, but I don't, as a category, software is still really is going to deliver great returns. And I don't think people are going to pull out of the category.
So, and I know a couple of you in the chat have asked for the data. I do have slides and I can share the data and the sources. A bunch of it comes from a Morgan Stanley report. There's also some Preqin data there, as well as some Crunchbase data and some other stuff. And Patrick Driscoll liked that we said himbos. So I just thought I'd mention that again. The good news in this is that if you look at the run-up in the assets, the run-up is not proportionally in the seed and pre-seed category. So that is still kind of relative to the rest of venture. It's a little less funded or a little more underfunded, and there's still real opportunity. You both are at multi-stage funds. So before this session, the founders in the VentureCrushFG program had a founders only session, and they funneled some questions to me to ask the two of you. And one of the questions was, as a multi-stage fund in the current market, are you looking much earlier than you were 18 months ago? And are you seeing founders approach you very differently than they were 18 months ago?
We're actually not really in multi-stage. I don't know, do you think we are?
Well, there was a little discussion in the room. Can you talk about Mustang?
Yeah, so we have a select fund, an opportunity fund, which is primarily to invest in follow-ons from existing portfolio companies. So because we keep our funds are really focused on seed investing. And then, but we have a pro rata that sometimes gets bigger over time if they're raising a $50 million round or a $75 million round. We didn't have enough capital for it. So we raised a kind of a follow-on fund that we call Cowboy Mustang. And we'll do a couple investments opportunistically in things that we missed where I didn't see it at seed, and Karen loves the company and calls me and says, hey, they're going to raise an A or a B and we think you'd be great to join. So we might do that sometimes, but it's really not our focus. We're very focused on seed.
So it's not reserved just for your existing portfolio?
It's like, I think that like contractually, I think we could do up to 30% of the fund in
Got it.
non-portfolio companies, but 70% would be portfolio companies.
Okay, makes sense.
Yeah.
And how about you? Because you are multi-stage.
We are multi-stage, and are you asking what have we seen change?
Yeah.
Or,
And are you moving earlier?
well, I don't know how much earlier we could go. We're unlikely to do, pre-product, pre-revenue unless it's a founder that we know. We have on occasion. But again, same thing. It's like it comes in through a trusted source and we might write a small check. Generally, we're fairly disciplined around, having some proof of product and some early revenue before we invest.
So let me rephrase the question. 18 months ago, if I came to you and said, hey, I've got this great company that we at Lowenstein, work with, they've got 100 million ARR, annual recurring revenue, and they've only raised $1.5 billion, and their last valuation was, I don't know, $4.5 billion. Like you're interested, right? That doesn't really happen today, and I'm seeing growth, funds that do invest at growth and funds that do multi-stage say, yeah, we really like it when they've raised a lot less money. And we know that there's going to be a real headache unwinding the valuation from December of 2021. And we'd rather spin cycles on something smaller and easier. So I'm not talking about the pre-revenue startup. It's more like at growth, even you're looking for smaller, cleaner stuff, right?
I would say generally, yes, that's probably on track. Our growth team is also incredibly thematically focused. So they generally have a good sense of the targets they're looking for and work with those companies over time. That said, we've seen a lot of disruption in software with Gen AI, and it's given us a whole new layer to think about and to focus on as we look at some of these companies. But yeah, I think you're right. We're looking probably on the growth team looking a little earlier than we might have a couple years ago.
You were about to say something.
I was gonna.
No, please.
I mean, I have to admit, as a seed investor, I think I understand why people who have over $1 billion funds do seed, but I don't think it really serves entrepreneurs. I think when you think about the economics of a $1 billion fund, right? Like the people who work at the fund and run the fund, they do make a lot of money on fee income, but their real job is supposed to be to deliver $3 or $4 billion of returns, right? And so if you're investing $2 or $3 million in a seed venture, the likelihood that the partner at the $1 billion fund is going to be able to return the fund on that seed investment is very low. It's a kind of a call option to be able to do the A and the B and the C and to be able to like back up the truck over time. But for founders, like that's basically what you are. You're a call option. And so, I think like in this environment, money is better than no money. But if you have choices, I'm biased, but I think it's important if you're going to talk to multi-stage firms is to go eyes wide open to understand that there's like a lot of other dynamics going on at the fund, and to maybe balance out your round with some seed focused folks who, so you can get the best of both worlds. Because we meet with a ton of founders all the time who have taken money from, a hodgepodge of multi-stage firms, and they're kind of abandoned right now. And I don't want to see that happen anymore.
I think it's a really good idea to, if you have those options, to create a very balanced group of folks around the table anytime. I mean, you want some folks who have deep industry knowledge. You want folks that have, go-to-market experience. You want people who have a variety of expertise. You're building your advisory board as much as you're building your cap table. So, do it thoughtfully.
And how much emphasis do you think people are putting on the fact that this company has brand name Venture Fund X in their cap table at this point? Because it does go a little bit to the point of, this huge fund wrote me a seed check because they were sprinkling the market with seed checks.
I don't know. If you look at an A or a B and you're like, oh, blah, blah, blah was in the seed. What does that mean to you?
I mean, I'm not going to lie. I certainly will think about that and be like, oh, they must have seen something really interesting here because these guys are so experienced. But I was thinking earlier, in fact, just earlier today, there's been lots of studies about, Fortune 500 companies and where did the CEOs go to school and how many were Ivy League and how many were, University of Iowa or whatever, and what impact does that have? And I was wondering sort of same, a lot of VC exits that we've seen, company exits we've seen recently, they weren't with necessarily the biggest funds. And in fact, in some cases, we've seen some of the biggest funds have negative outcomes. So, what is the name brand of the VC really doing for you over the long haul? I'd love to see stats on that. Maybe you have some of those. But really? Oh, that's cool.
Some, yeah. I mean, it's a little bit bullshit. So the problem is that, the comment that you made, Aileen, about the quantity of funding that a given institutional LP, like a pension fund or university endowment, needs to deploy at once, has inflated the asset class and inflated fund size. And when you have that kind of fund size, you build a big team, you build a big platform, and we have been fighting a battle about the extent to which after investment services are going to be an enormous selling point. And I'm not saying that, that's not a valid perspective. And I'm sure that BCG, for instance, and that's a very different case, adds a lot of value both in the investment process and after in investing. But there are venture funds, and we know them well, that have spent an incredible amount of money on PR and branding so that they can magnetically attract a lot of startup opportunities. And then it's really hard to pick, but people have bragging rights about those funds being involved. Some of those funds have gotten very, very large. Some of them, started pretty large. And when you look at the analysis that you did, Aileen, with your amazing, groundbreaking unicorn research, which I hear you are revisiting.
Yes, we are working on an update. It's the 10-year anniversary as well.
And which I have made required reading in my class. It's great. It's great research. And one of the things that you talked about is that there was this this was in your 2015 second phase of the research. You talked about the fact that there was a huge run up in the number of unicorns as well as in the aggregate value of the unicorns. And you said it's the number of companies, not their individual valuations, driving the dramatic increase in total value among all unicorns in the market. And there has been this thesis in venture that there are 10 to 15 companies a year that matter, and you just have to get your piece of that pie. And the branded firms are the best at doing that. And then the other part of that thesis, which I'll say now appears to have been a fallacy, is that success persists and you see the same brands in those huge outcomes year after year after year. But it turns out that a much larger set of venture funds are participating in the top 100 liquidity events or exits each year. And it also turns out that we did have a period where 10, 12 companies were the majority of value in the top 100 exits of the year. And now it's 60 to 80 companies. And that is a huge shift and a huge democratization of venture fund performance. So you have a fund like Mucker Capital in LA, where everyone else passed on Honey. They did Honey, they returned more than 20 times their fund. You know, I don't know how many people in this room have heard of Mucker Capital, and it doesn't quite matter.
Altos Ventures and Roblox.
Yep.
And not just Roblox, right? Coupang and but exactly. So
I mean, I guess somewhat related is like, one of the things that's been driving this chasing of scale and growth has been the fact that M&A has been pretty dead, I would say, for the past 5 years. That a lot, you know, in the dot-com boom and even afterwards, you know, AOL, Yahoo, like even, you know, Dropbox and Box, when they were private, they had these incredible currencies and they would buy startups for $100 million, $300 million, $400 million. And so, you know, if you had not raised very much, like maybe you raised $3 or $4 million, you got bought for $250, you were super psyched, your investors were super psyched. And that kind of dried up in the past 5 years. I'm actually curious, and I have a feeling that smaller M&A will come back. And so that for smaller companies, because you have these giant companies that have massive market caps. And so, I mean, part of the reason why small M&A kind of died is that a lot of people, again, they had more money than they had people or time. So they would buy stuff. And then they found out that acquirers or like small acquirers, like they wound up shutting down the products and not really using people. And so then like, they were like, this is not worth it. But I do think that actually buying companies that are maybe $20 to $50 million in revenue, that have teams that can be distinct products or distinct and like fill a hole in the roadmap. And this is how Cisco built itself over years, right? They have an incredible M&A team. I do think the big tech companies are probably going to come back to M&A, which will actually maybe change the game for venture a little bit and for founders a little bit, because you just have to be careful with how much you raise. Because it can be a great outcome for you and your investors as long as you don't raise too much.
And you mentioned Acquihires. Is that the sibling of Aquaman, or do you want to explain what it is?
Acquihires was just basically like, I'm desperate for people. I can't find talent, which is not really the case right now. So, but you know, if oh, this company has 20 engineers, I'll pay $1 million an engineer. Your company's worth $20 million. Like that's kind of what happened 10 years ago. And it kind of, it stopped happening, but I don't know what you think about that.
I just think, you know, the scary part about the M&A market, and I think we're going to see a ton of mostly undisclosed M&A, because there are companies that can't raise, you know, aren't living up to their expectations, and they're going to have to sell themselves. And unless they have multiple competitive offers, then it's going to be very difficult, because as we all would, you know, you want to get the best price possible. And so the buyer has the power. And I think it's really going to be scary for some companies. So if you can create at least a little bit of competition around it, you know, then maybe you'll see it. Or unless you can develop the strategic imperative, you know, for that target, you know, then it's a different story. And that's, I think, what we just saw with Splunk for Cisco, is it was strategically important to them.
So let's talk a little bit about how you actually get the money today. And there was a discussion in the founder-only room of how to think about making sure that your pitch is landing. And someone asked a great question, which was, can you think of a company where you didn't quite get how important the company would be? Others did. You didn't fund it. Others did. Or if you'd prefer, you did get it, you couldn't convince your partners that they should get it, and you didn't get to do the deal. There is a follow-up.
There's so many. I mean, I think it's always the tug of, you know, it's the push-pull of venture. I think sometimes I fall in love and my partners don't. And, as compelling as I think it is, I can't convince them same. I had a company last fall that actually was kind of an early Gen AI. Like, when did the Gen AI hype start? Like January? Like, when was it every sentence of every conversation? Like January, something like that. This was last fall, so it was almost a year ago. And it's a company I really, really loved, and we almost got there, and we didn't quite. And it's in the Gen AI space, so I feel like that was a big miss. But I feel like, and I'm kind of going slightly off, but I want my partners to love the companies I love too, not necessarily for the same reasons, but I don't really want to, push a company through that my partners are like, I want us all to be kind of around the table with it. How do you feel about that?
Anecdotally, I've heard from a lot of venture firms that the non-consensus investments are the best outcomes. So, there's a couple. I brought Square, when I was at Kleiner, I brought Square in for the Series A and the Series B. And it got pooped on both times. That would have been like, we'd be on my yacht right now. And
all of us.
Really
but do you regret that you didn't
I regret
push?
that I didn't push harder.
Yeah.
I wasn't a senior partner yet. I had done a ton of diligence. Jack Dorsey was not Jack Dorsey today. He was Jack Dorsey who had gotten fired from Twitter. And he was basically unhireable. Like, his references were horrible because he got fired from Twitter. And the coach that had been brought in to work with him was like, yeah, I'd never worked with that guy again. And like, that was in my diligence binder. So like, basically I brought him in, and then my partners were like, did you read your own diligence? Like, why are we even having this meeting? And I don't think I had the confidence. And this is part of like what happens in a bigger firm is like, you really have to armor up, and you have to be really prepared, and you have to really like be ready to go to battle. And I think I just wasn't like, I didn't have the constitution for that kind of battle. But, to me, the dongle seemed, because I don't know if you guys remember, there used to be this dongle that would go into like the ear jack of like an iPhone. And it seemed really iconic to me that you would be at a farmer's market and see some guy who used to only catch, or a woman who only sold in cash. And then she is collecting credit cards, and everyone else is like, hey, what's that thing? And then you could imagine like the whole farmer's market would then be collecting credit cards, right? And then it would just like kind of spread by, and there's hardware risk, there's payments risk, there's a bunch of like, one of my references was Jeff Jordan, who used to be the CEO of PayPal. And in the diligence, he's like, oh my God, like payments is a giant effing nightmare. Like, you have to get fingerprinted in every state, you can be personally liable, like, and everyone was like, again, did you read your own diligence? Like, this is a really, like, you don't have any payments experience. Jack is like, and I basically said it, but I didn't say it in a compelling enough way. Like, yes, but he is, our business is all about outliers. It's all about taking risk. And he is a product, probably like a product genius. Yeah. And that's our job, is to back product geniuses. And the worst thing that can happen is you can lose 1 time your money. But, and so I really wish I had pushed harder for that.
What's your advice to both young VCs who are in that position, and also to founders who are trying to help arm their inside champion at a venture fund with the stuff to overcome that kind of resistance?
At the bigger firms, you have to have allies. You have to pre-wire the investment before the investment comes in. And that's the thing I think I didn't really understand as well as I should have. It's like, I should have brought 3 people with me, along with me the entire way. And I tried, but like, it's just hard because a lot of times partnerships, and like, your VCs are never going to tell you what it's really like working in a VC firm. There's a lot of politics. It's like, it can be zero sum. So it's like, if I'm doing well, that makes Karen look like she's not doing well. So, this is not really how Karen operates, but other partnerships work is like, there isn't really an incentive sometimes to make someone else look good because it makes them look bad. And so, you can bring 3 partners along with you to kind of convince them, but then they might stab you in the face in the meeting and you really can't predict it. It's like, that's the real talk of what happens at some venture firms.
I certainly don't see that with we have this great little group on the Ascent team at B Capital where it's just 4 partners.
Yeah.
And so I do that all the time.
Yeah.
You know, I'll call my
stabbing
partner.
in the face?
No,
I
we
just
no
couldn't tell.
stabbing in the
Sorry.
face. No, building consensus
Yeah,
around
but that's
deals.
because you have a smaller, like the
It's
early
very-
stage
yeah.
team is smaller.
It's small enough
Right,
that
yeah.
we can do that. And so just to sort of, you know, clarify what I said earlier about like, I don't love doing deals that my partners hate. They don't, if they hate it, it's a non-starter.
Yeah.
If they're on the fence about
Yeah.
it, they're gonna back me. They're
Yeah.
gonna say, you know, if you feel really strongly, you've
Yeah.
got my support on this.
Yeah.
But I think you're right. It's the benefit of smaller team, worked together since the beginning of this fund, the early stage fund, and a ton of trust
Yeah.
and confidence in the diligence process that we each run.
Mhm.
Which still doesn't mean that every single deal I want to do goes through, which is fine.
So I'm going to do 2 more questions here, and then I want to hear from folks here or in the chat. What is product market fit, and what's a good example of one of the scrappiest ways you've seen a company demonstrate that to you as a potential investor?
But sorry, before we move on to product market, because for founders who are thinking about raising your next round, you know, obviously you want to have a first meeting with the partner and see if like how interested they are. If they seem interested, and if you have mutual interest, then one of the things you can ask is, what's your process? How do you make decisions? Can you make a decision alone? Do I have to have full partnership? Is it like, do you need unanimity or is it majority? You know, and if you're worried about it and you're getting to the place with the partner that like they are interested in bringing you in, then just say like, what percentage of the time do people not make it through this final meeting? What are some like, can you give me some examples of some times when it has not gotten through and why? Just, you know, just be open about like, look, if I'm going to spend the time to go to this place with you, like just help me be educated about your process, because they have the same incentive that they're bringing you and they want to get it approved.
That's really fair.
That's great.
So product market fit. It's, you know, it's elusive. And if you look up like the traditional definitions of product market fit, it's a little distressing because it sounds like nobody's, you know, there's 3 companies in the history of the world that have ever even actually had it. So they make it sound like it's just so, you know, and I think it's probably easier like with a Square, even though that's an enterprise company, because there was, you know, definitely some people seeing it and wanting it and that sort of thing out there. But, you know, like I think there's an easier, more relaxed definition of what it takes to demonstrate at seed that you've got some at least indication of product market fit. And I definitely think it has to do with some of the foundational things that we all look for. You know, has anybody bought this? Do they like it? Are they using it? And, you know, will they want to buy more of it? And they're telling their friends about it? So when I think about, you know, kind of traction at the earliest stages, those are the things that I am most concerned with, you know, and I want to talk to a customer before I invest if that's possible. Sometimes it's not possible until I commit, and then you'll say, okay, fine, you can talk to a customer now, understanding that may have impact on my decision. But, you know, I think it's extremely compelling when you're talking to a founder and they can say, you know, I talked to these 10 people and these 10 people want to talk again, you know, even if you haven't closed the deal yet. And then of course you want to see people that are paying for it. I don't mind at all if your first few customers aren't paying full rack for the service, you know, that's okay. But have you negotiated something in return? You know, did you say, yes, I'll sell it to you less expensively than I will later, but in return, I want you to do a case study and I want to be able to use a quote on my website that you love the product and whatever. So I think there's some balance there in getting and establishing some traction at those early stages. But I definitely want to see that multiple people are buying, that, you know, they love the product, that they're likely to expand. There's pull.
It's not a hard sale.
Yeah. Yeah, that you're solving a problem that people need solved.
In ways that you've seen it demonstrated, like in a scrappy early context.
Yeah. So I mean, I have a healthcare company that's in a space that I think is generally perceived to be somewhat challenging. And they attack the space a little bit differently. They are going through enterprise partnerships. And it's been, it's really running. It's really doing well with that type of an approach. So, we're replicating that now. We tried it a couple times. It's working, and we're back at it. And now we're saying, let's do this 100 times. So I think it's each company, I think, is going to have different formulas for what will work.
I mean, if you're enterprise, you're looking at your retention rate, right? Like your renewal rate, your expansion rate. Like there's a bunch of, when you're in market, there's a bunch of metrics and same thing in consumer, right? You're looking at, frequency. Is the average order value going up over time? What's the repeat rate? What's the return rate? Like, what do the reviews say? Like on the internet, even like and then we also even look at Glassdoor reviews for your company. If your company's got has 20 or 50 employees, like what are people saying if like you work at your company? Because we're seed and we do majority of the time it's pre-product market fit. So what we're looking for is who are the founders? What's their idea? What if they figure it out on very little money and little time and little resources? And ideally, we get to know them over a course of a couple weeks, and we'll just kind of pepper them with questions. And a lot of it is how they digest information and synthesize it, and then come back to us with kind of what they're learning or how they're adjusting their thinking as they get new information, or as we ask them questions. It's kind of like the speed of learning. And just kind of like this scrappiness. So, Guild Education is a company that we're very proud to be investors in, and we invested in it. I think it's guild.com is the website, and they partner with employers to provide education and skilling as a benefit to mostly hourly employees. And like Walmart is a customer, hospital systems, like Tyson Foods, Target, all these, they like who have millions of hourly employees who are looking to get a better hourly paying job. And they're looking to get either an education or the skills to be able to go from being a cashier to being a forklift operator, or going from being a cashier to being a home healthcare worker, or something like that. So, and the team basically was in grad school when we met them. But what they had this idea about skilling and education, and they had basically been driving around Palo Alto, and they found like empty strip mall space, and they called the landlords and said, hey, like, can we pay $50 to use your empty space? And then they basically crafted a pitch and put it on Craigslist, and they started doing boot camps for people on their careers for free, and then for $40, and then for $80, and then, and for 2 hours and 3 hours and then 4 hours. So when we met them basically over the course of 3 or 4 weeks, they had been doing them like twice a week and learning. Like, oh yeah, like this time we're actually going to try coaching. We're going to give everyone our cell phone number. We're going to ask them to try and commit to like apply for a job a week. And then we're going to pair people up and have them like, they just had all these ideas of all the things they were going to test. And so it was kind of like that grit and that hustle. And like, there's almost nothing we could ask them. They hadn't been like, oh yeah, we thought about that. We tried that, but like, it didn't work. And it's kind of that mentality that we're really looking for.
There's also nothing like a founder who does what they say they're going to do. Yeah. Right. Like whether it's a company that I've already invested in that, says next quarter, this is what we're doing. And then at the end of that quarter, you're like, did it all. Like, that's amazing. Like it builds such trust and confidence. I also want to see that in the, before I invest. And we have a phrase inside our walls where we call it rocket person, rocket ship. That's like our foundational kind of, are they both? If they're both, sweet. Mm-hmm. If they're not, which one are they? And do they have the potential to be both over time? And what would it take? But also really like what you said, like you talk to them and you say, well, what about this? And they're like, gosh, I really haven't thought about that. Let me get back to you. And then they actually do. And they come back to you with something really thoughtful. Yeah. It's incredible. I have one founder that's coming to my mind right now who, it's a company in the vegetation management space. And so when the Maui event happened, it was kind of front and center, and, talking to him about like, in a terrible event, what do you do to elevate your solution and make something positive out of something, pretty tragic. It's something he came back to me with some really, really thoughtful approaches. Like, I love to see that in a founder. It's great.
All right, who's got questions for Karen and Aileen? Go ahead.
Do you think that antitrust environment if so, do you think that'll change?
I certainly think for the biggest companies, it's limiting it, but there's plenty of other companies that are not Amazon and Google.
Just at the largest
Yeah.
levels,
Yeah.
though, not stopping them from spending $200 million on something. Yeah. You had a question as well?
When you were firefighter, did you work for a company?
No, I did not.
Oh,
No, he was gone.
I thought about it when you mentioned the job.
Oh. Yeah, no, I've never done this yet.
And sorry. And can you talk a little bit? We've got a company, and I'm happy to take some more. We have a company that is a consumer company. You've both worked with consumer, and they are a masstige facing company. They have a mass market opportunity, and they're trying to figure out, do we take the opportunity that changes who we are? Is it possible to attack both opportunities? And we can really ramp revenue because of this new mass market opportunity, but it does kind of change things, and it certainly changes margin. How should they think about this in the current market?
This is a fork in the road. Like, do you walk through a new door or just stay kind of in the current place that you're in? It's kind of hard to answer without looking at who it is, the numbers.
What are some things that you might want to know, or analytic framework you might give them?
I'd certainly want to know what their current funnel looks like in the market that they're, primarily targeting. And, and then, some of it can be pretty financially based, right? Like, what are the differences in the finances as a result of one versus the other?
Would it scare you to be looking at a company that has that opportunity set because which way they go? Or is that, I assume that's something you help them navigate.
Yeah. Like, it's funny, we're investors in a skincare company called Matter of Fact that has amazing products, by the way, if you're into skincare. And they were kind of B2C, and then basically Sephora came calling. And that's a really big decision. It's like, because you basically, when you partner with Sephora, they ask for exclusivity. They have a lot of requirements about how much inventory you have to buy and the packaging and a bunch of other stuff. And you're kind of like, should we put all our eggs in that basket or not? And we decided to, but it was like a good conversation where there was lots of numbers involved, and there's pros and cons and risks and, what different scenarios about, and you kind of stare it all out in the trade-offs and you decide.
So there's a go-to-market question, which is Google spend, Facebook ads. Are those now a thing of the past? What for consumer or B2B has become the new go-to to get people to know who you are and to use your capital efficiently to get people to know who you are?
Well, personally, you mentioned that PR was very expensive. PR doesn't have to be very expensive if you come up with an approach, whether it's using Twitter, LinkedIn, other sources to get your message out. Or I've told the story previously about how at Box we were positioning ourselves to be competitive with Microsoft SharePoint. And we took it upon ourselves to figure out who all of the writers at all the various pubs who wrote about Microsoft SharePoint were. And when we knew that there was an announcement that was coming out of Microsoft in the upcoming weeks or months, we'd reach out to every single one of those writers and talk about Box and how great Box was. And it was a pretty successful approach because we were often mentioned alongside of these, SharePoint announcements. And that was just a strategic approach that we took that ended up being reasonably successful. So and that doesn't cost money, it costs time. And you just have to decide whether that's your approach. And, I've worked with founders who had taken, kind of an approach separate from PR, but like more of a broad-based, I need to reach a lot of people, and found that, you know, their product actually was much more targeted, and they needed instead to take an approach of like hosting small intimate dinners with corporate leaders who may have this problem. And that has been a much better approach for them. But, you know, it depends on the company and knowing who your target audience is and how those people buy in order to, you know, get to your approach.
And speaking of approach, how do people actually approach the two of you and get on your calendars? And I know it's an unfair question, but the question really is, you know, you have your scarcest resource is not the capital you're deploying, it's the time you have to get to know a company over 2 or 3 weeks, or now, you know, 2 or 3 months. But like, you have so many opportunities. What are things that would make an opportunity jump up from inside your inbox? Or is it even inside, like, is there even a way inside your inbox at this point?
For us, you can email hello@cowboy.pc. We look at everything. Can't say we're going to schedule a meeting or a call with every person, but we look at everything. It does help if Ed or someone who I know sends an email and says, "Hey, I know this founder and I vouch for them."
Yeah, so email Ed.
Yeah.
He'll send it to us.
So the good news is we're now going to discuss warm intros in Venture. And you're going to talk about
We do
your.
not require warm intros, but
Okay.
warm intros do help.
It's nice.
But what else?
No, they're going to invite me back. I'll take one more. I had a lot of fries. Thank you.
Was he ordering
Is that the
fries?
voice of God? Who was that?
I think he was ordering fries. But are there other things outside of warm intros that you've seen people do that are really effective to like get on your radar at this point? That's the answer, by the way. It's hard.
Yeah.
Is it hard?
I have responded. I don't respond to every single email that I get. I don't, I have to say. But I have responded to inbound cold emails and taken meetings.
I would say one thing not to do is do not auto-subscribe people to your
Oh, God, no,
company's
please
email
don't.
list. Like, I cannot believe how many founders basically are doing MailChimp or whatever and just spamming VCs. Like, I unsubscribe immediately.
Yeah, I don't like that either.
But it's a lot harder now to get above the noise than it was 10 years ago.
I mean, I think,
No?
I mean, 10 years ago, most companies were in the Bay Area and most VCs were in the Bay Area. And now you can be successful having a distributed team. You could be based in Boulder or Brooklyn or South Carolina or Australia. Like, you know, founders can come out of any background and out of any geography. And we look at like the most successful founders that we backed. Some of them had tech pedigree and some of them had no tech pedigree whatsoever. So I think more than ever before, people realize that you don't have to be like a hoodie wearing Harvard 20-year-old dropout to build it.
Speaking of which, the only questions that were posed inside the room were from dudes. Are there any non-dudes who have? Here we go. Go ahead.
So for a pre-seed startup, what are your thoughts on design partners as a point of traction?
And design partners are great,
Yeah, agreed.
fantastic.
What are like typical terms of like length, duration of course it would depend on the product, but and the way that the design partner was introduced as well.
And to be honest, it doesn't, I mean, a lot of people, their first 5 customers, 3 of them are like, my friend worked there, or my former colleagues were, that's totally, I think it's more like, you know, is it a design partner that is going to buy the product is the kind, and is reflective of the kind of customers that you want to have in the future? And how unique are their needs? So oftentimes, you know, you want to have 3 to 5 design partners so that, and then they're credible names and they have the opportunity to actually become paying customers and ideally, you know, land and expand over time.
But don't over exaggerate their commitment to buy. Like, unless you're 100% certain they're buying, like, don't tell me you're 100% certain because I'm going to call them and talk to them.
Other non-dudes with questions? Go ahead.
You guys
you repeat the question?
She's asking about our corporate backgrounds and how we were able to take the skills from those backgrounds and parlay them into venture, and also what were we missing that we didn't get in our corporate space that we filled on our own. Well, maybe I haven't filled all of them yet. I don't know. I think I have some gaps still. I think, you know, a lot of what you learn, at least from my perspective, at the companies like Box and at Apple and even at Prosper, you know, you take different things from each of these opportunities, you know, and you absorb them. One of the things I think about a lot at, you know, from my experience, particularly at Box, is like how you begin to see around corners from, you know, mistakes that you've made in your own role or as an executive team in these companies where you're like, oh God, we missed that, you know, and then, you know, all of a sudden you're talking to your portfolio companies, and you're like, don't miss that, you know, because you experienced it. And I think that the great thing about being in a corporate environment is, you know, you learn to prioritize. You have limited amounts of capital, you have limited amounts of time and people, and what can you do to maximize those? And then you take those lessons forward to the companies that you're working with. And that for me was the most valuable. And I think what I missed on the corporate side is I was never a finance person, and so I've had to beef up my ability to advise on, you know, on things that you know, maybe somebody with investment banking background might have. And you know, I do that through my own teams, through their experiences and their knowledge, as well as, you know, some of my own independent learning on that front.
Yeah, I think you said it really well. I mean, you learn how to collaborate, you learn how to communicate, you learn how to be prepared in a professional corporate environment. Work ethic, like you have to show up and be prepared, right? I didn't have startup experience. So actually when I was at Kleiner, that was one thing I noticed, like a lot of my bosses had startup experience. So actually we had made an investment in a Series A company that was not doing great. And I started spending more and more time with them. And then they actually asked me to come in and be the CEO. So I did that. I don't know why I thought I was gonna do it for the summer. They were like, will you come do this for the summer? I was like, yeah, sure. And I'm like, that was very naive. Like I wound up doing it for 2 years. You can't be the CEO for the summer. But that was really helpful because I had to raise a Series B, sell some big partnerships. I had to basically recruit a VP of product, a VP of sales, a VP of engineering, and then the recession happened. We had to lay off half the company. We basically kind of like had to kind of live through winter. I had to do lots of selling. And so I kind of realized how hard a lot of that stuff is. It's like, I think that was very helpful.
That's great. So there's a question in the chat, which will be our last question. I want to do one current event in venture thing. And it's from Tyrone Smith. The question is, what do you suggest that we do to overcome, quote, expertise signaling, self-presentation that might not align with reality when it comes to their experience, skills, or background? How has that played a significant role in their company's success? So do you get the question? So there's this notion of pattern matching, and I've seen the expertise before. How has someone overcome the, I don't match the pattern, but I'm really good at this?
I mean, I think, you know, we're looking for authenticity as well. It's not just, here's my resume, write a check. Like some of it is, do we connect as people, as humans? Do we align on, you know, culture, you know, what you want to build, how you want to go to market? Like, are those things aligned? And while certainly, you know, if you're starting a healthcare company, I'd like to know that you have some healthcare background, some insights on healthcare, or have really tight connections, or a co-founder that's an expert. So there is, you know, of course, some foundational expertise that I think is required, but I don't think that it has to be in the exact mold in order to be something I'd be interested in.
I mean, if you look at the Airbnb founders, right? You know, those guys came out of hospitality. They came out of RISD design school, right? They didn't have any, like our whole industry is pattern matching of people who actually don't necessarily have like the experience or the industry knowledge, but they have an idea. and they've got incredible hustle and grit, and I mean, I do think storytelling is a really important skill to have. You need it for selling, you need it for recruiting, you need it for fundraising. And so practicing your storytelling ability kind of off Broadway with friends, with other founders before you meet with investors is a good idea. But I think it's a combination of like the storytelling and then kind of the bring it, the hustle, what you figured out very little and how you synthesize information.
Speaking of storytelling, there's a story in the press yesterday about the Fearless Fund, which, as many of us in this room have been watching this lawsuit that was brought by Ed Blum and his group. He's raised more than $700 million to take the affirmative action decisions from the Supreme Court, where he funded the plaintiffs and bring additional litigation to oppose affirmative action. And he sued the Fearless Fund, which is a $26 million fund in Atlanta, owned and run by Black women. They had a particular program that was giving $20,000 grants to Black women-owned businesses. And he sued on behalf of white and Asian plaintiffs, saying that they were discriminated against, excluded from the opportunity. And yesterday, the court sent down a 22-page ruling on a motion for what's called a preliminary injunction, where the plaintiff had sought to preliminarily, or for a limited time before a full trial, stop the Fearless Fund from giving out these $20,000 grants to Black women-owned businesses. And I read the analysis with interest. I happen to be an investor, proud investor in Fearless Fund through First Close Partners. And the judge found against the plaintiff and said, I will not enjoin this program. And the Fearless Fund can continue to do this. And I don't know how many of you have been following this case. It's something that I'm happy to talk more about. My colleague Latoya Bethune also did some, has been doing research on this, as a number of us have been watching it. But it's a really important case in our industry, and it's much more broadly applicable. And it's also noteworthy because the law under which the plaintiff brought the suit was a law implemented just at the very end of the period in American history during which enslavement was lawful. And they have turned it on its head to use that law against the things that it was designed to protect. It was designed to protect equity for people who were no longer being trafficked by Americans. So really interesting outcome in the case, and really fascinating reading for other legal geeks, but it's also something I'm more than happy to talk more about. So I want to thank all of you for being here physically and virtually. I want to thank the two of you for all that you do in the community, because you both do a lot to support the community, to support underrepresented founders and investors, and to build things with purpose, which is amazing. And I really appreciate you being here at Lowenstein Sandler for today's Venture Crush event, and want to thank everyone on the Lowenstein team who makes these events happen as well. We're gonna, for those here live, we're gonna stick around, and we have great breakout rooms to discuss the things that we've been talking about today. And you should have, I think, on the back of your name tags, you've got rooms, and if not, we will get you into breakout rooms, and hopefully folks will stick around for drinks and chatting and to trade email addresses that hopefully will get read. But thank you all so much for
And I just want to take one moment to thank Ed.
Yeah.
Because he has done so much. Amazing. Thank you for all
You're
your
a
work.
warrior for justice. I'm a much appreciated one.
Thank you very much.
And the reward is a lot of emails.
It's Aileen@cowboy.com. That's my new email address for all of you.